Hi, welcome to the second of our videos on ratio analysis. This one steps up a little bit from the last one, and time to do a little bit of analysis. Okay, what we've got here are two statements. An income statement showing profit and loss, and just a quick explanation here. We've got what's called the operating expenses, interest expenses, income tax expenses. So we've got three lots of expenses here. And that's a little bit more detailed than just saying net profit. Okay, so we'll come on to that in a second, but please bear that in mind that we are dealing with a different set of profit figures. We're going to the balance sheet. Right, okay, you've got current assets, non-current assets, right? So we've got our assets there, and you can see that that includes the current asset includes with $200,000 of stock. Non-current asset liabilities, there's money borrowed normally and shareholders' equity. So here's what we're looking for. Okay, well, without further ado, let's start straight away with the gross profit margin. That's the figure we're looking for. So if you remember from the last video and from your other studies, the gross profit is what we're looking for, will be the revenue. So we know what that figure is, 500,000. And we deduct from that the cost of goods sold. And that is given to us as 200,000. So we have a gross profit. And that's the figure we need. Now, to find a percentage, all we do is they take the gross profit, divide by 500,000 and express it not in currency, but as a percentage. There we are, gross profit done. What it means then is that for every $1 of sale, the gross profit is 60 cents. That's what we pay for the goods. Or in a manufacturing company, that's what we pay to make them. What we haven't done is taken into account expenses. Now, I did say there were sort of two definitions of profit here. The question down here has asked us to work out the operating profit margin. All right, the operating profit. So what we actually now need is we now need to start with the gross profit. Okay, because we're going to take away from that any operating expenses. Okay, excuse my little bit of clumsiness with this. So what we want is the operating expenses. And if we take that away from the gross profit, we will end up with operating profit. Okay. So what do we do with that figure? Well, we take that figure and we divide it. Be careful, mind, not to the gross profit, but to the revenue each time. And express that as a percentage. That figure will be lower, providing you're in a comfortable position of being in profit. That figure will be lower. Well, let's take it one step further. Let's have a look at the net profit margin. Well, What we now want to do is to work out what the net profit is. So let us start now with the operating profit of 150,000. And we now have two expenses, the interest expense and income tax expense. Now, these are expenses which, you know, haven't been incurred because you've been running your business on a day-to-day business, selling, moving stuff around, paying people and all that kind of things. These are financial expenses. We don't really want them included into the operating profit. We keep them separate. This is to inform the shareholders. However, these are real figures. So what we're going to look at now is a different profit figure. So the total of our expenses regarding interest and tax paid, take those two, remove them from the profit, and we now have the net profit. But of course, we want to express it as a percentage. So we divide that. Now remember, go back to the revenue and express it as a percentage, 24%. So for every dollar of sale, we get to keep, after taxes, interest, expenses, and everything, 24 cents. Is that good? Is it bad? Mentioned before, it really does depend upon the business that you're in. If you're selling low turnover, expensive items like furniture, even cars, these kind of things, household durables, that may be regarded as reasonable, might be a bit low. But what the way to actually do it is to compare it like with like. Look at other industries, look at other businesses of about a similar size or working in the same type of market and compare it with them. And compare it with your previous numbers and figures. Okay. Well, what about the return on assets? Right, okay. What we want then is the value of our assets. Well, first of all, we will want the net profit. Okay, I'm going to need the net profit because that's what we're going to compare net profit against the value of the assets. In other words, how hard has the assets worked for us? Right, so what we've got to do now is to look for the value of the assets. Well, let's just have a look. In the balance sheet, you'll find that. So you've got current assets, 300,000, and non-current assets. Oh, look, there's our assets. I'll just write that as current assets. And we've got non-current assets. And we've got those figures as 300,000 and of course 400,000. Let's now add those two together. Let's be even more specific. Total assets will equal the two added together. Okay, so 700,000 of assets is earning us $120,000. Okay, fine. Let's just express that as a percentage because the question has asked us to. So that's 17%. Really not bad. How many assets? Your uncle's parent, whatever, may have money put into the bank, saved. You got to ask them, your savings earning 17%? Highly unlikely. Okay. We've got another one. What about return on equity? Well, equity is what the shareholders own. So let's get the net profit again. You get a little bit deja vu with some of this stuff because you might think, oh, well, there's variations on the same thing. Well, what I want to know is if I'm the owner of the business, how much is my dollar earning? So let's look at the shareholders' equity. What's it worth? Well, we don't have anything fancy in there. Now, again, try and understand what shareholders' equity is. It's not just the face value of shares. It includes things like premium of shares, any reserves held, any profit earned. It's what the shareholders belong to them. And if I express that in exactly the same way as a percentage, then I've got 34. Now that does look good. Okay. That does look quite good. Just be careful, mind. You may have a high show of equity, but this may impact on the value of the shares one way or the other. But of course, what is the risk involved in the business? So see, there's so many things we don't know. But the important thing about ratio analysis, it is a way of comparing, as I say, like with like, past and present, but it also gets you thinking and asking the right questions about the performance of a business. Okay, let's sort of summarize what we've got there. I'll go back in the next sheet and get a bit more on this. But these are what we call profitability ratios. Profitability ratios. And of course, not just ratios, but percentages. Okay, so what is that? Okay. Let's now look at some other data. Let's have a look at some liquidity. I've only got the three there. So this isn't going to take long. The current ratio, nice and simple. Start with your current assets. Okay, and we've got that figure. As you can see, I'm a bit too hasty with the keyboard, so let us look for the current assets. We've got that figure, current assets, 300,000, and we divide that by the current liabilities. And remember, it's expressed as a ratio. In other words, there's no symbols in front of it or after. Right, so current liabilities, we've got at 200,000. So current assets divided by current liabilities, and just to remind us, that is to be expressed as a number, please, not as. Okay, so we've actually now got a figure of 1.5. Well, that means we could, our current assets are 1.5 times more than the current liabilities. Is that good or is it bad? Well, it does depend upon the nature of the current liabilities, I guess, and the current assets, of course. In other words, it's supposed to be a measure of how easily you could settle your immediate debts. Your immediate debts could be, for example, money owing to your suppliers. It could be money owing to your employees if you still have the payroll hasn't been fully settled. It could simply mean money owing to the bank in interest. But anyway, these are the creditors. How easy? So what are the nature of the fixed assets? So what we'll do is we'll look now at the quick ratio. Okay, it's asked for down here. What we do with the quick ratio is we do not include the stock in the current asset. So it's done exactly the same way So let's start with the current assets. And what we'll do is take the inventory away. Okay, I'll try and explain that in a second. So the inventory we've got at 200,000. Okay, so what we're going to do is we're going to call this liquid assets, for want of a better term. Now, even that could be disputed because basically your current assets are traditionally made up of inventory, which we've now taken away, cash. You can't get any more liquid than raw cash. That could be in the form of bank deposits, easily accessed money, which can be paid to your to settle your debt, and of course, money owing to you. How easy is that to actually get back? So you might want to do further analysis as how liquid is that really? Now, I'm assuming it's fairly liquid. Why not stock though? Well, next time you're in a store, if you're in the UK, Tesco, or if you're France or Europe, Carrefour, of course in the US, mighty Walmart, look around those stores and look at the stuff on the shelf. And of course, that is the inventory, that is their stock. It is liquid. You don't have to look at the checkouts as they leave it. You know, the stock is just pouring out of the stores. The thing is it goes out of the store in one way, at the back entrance, it's coming in just as quick. It has to. Otherwise, by definition, if those shelves aren't got stock on them, it is by definition not a store. That's what the Americans call it, a store. Okay, in the UK, we call it shops. Taken from the verb to shop. Americans use to store because they're storing goods on the shelf. But without the store of stock, without the inventory, it is no longer a shop. It is no longer a supermarket. So effectively, the inventory is almost permanent in order for the business to survive. Now, you could apply exactly the same to a manufacturer. If you take away the raw materials and the stuff that they need to make the products with, it ain't going to be manufacturing because it's got nothing to manufacture with. So probably it's not a good idea to use this ratio for what our purposes. So, okay, everything else, though, is exactly the same. The current liabilities is the same. And I can safely copy that into there. And we will get a lower figure. We will get a lower figure. As you can see that if I apply the same format to that, it's now 0.5. This would suggest, on the face of it, that we're not very liquid, that we don't have enough liquid assets, 100,000, to cover our current liabilities. So, you know, I might be a little bit worried about that. I might be a little bit worried about that. Okay. Finally, debt to equity. That might help us throw a little bit more light, not much, because we've got very little data to work with over here. This isn't very detailed. I mean, if you look at a company, if you look at company accounts, when they publish their end of year reports, we're not talking about a spreadsheet like this. We are talking about a document that runs into quite a little thick document, giving a lot of detail. So what you can go on to any stock exchange, for example, New York Stock Exchange, London Stock Exchange, pull out a company report and make your own judgment on that. Don't just rely on my say so. Right, okay, debt to equity ratio. Right, well, what we want to know then is what's the total debt? Right, well, look at your balance sheet. What is the total debt? Okay, well, it's these two put together, isn't it? So there's liabilities and more liabilities. What are the numbers? Well, 200,000 and 150,000. So the total debt is 350,000 on those figures I've got. Right, well, what's the shareholders' equity? Well, the shareholders' equity is also 300,000, 350,000. What does that actually mean then? Well, what it actually means is that we have a ratio of 1. So for every $1 you've got in your business, your financiers, your banks, your borrowers, your current, your all the people, all your creditors, whether they're banks or even your own employees, they put in the other half. That's 1 for 1. Okay. Our future lesson, I'll talk about gearing, which is a little bit different. So let's do a quick analysis on that. Not that it's brilliant, it's very brief. So on the analysis, we've got, it demonstrates healthy profitability ratios with strong margins across the board. Okay, maybe, but let's compare that with that. What about return on assets and equity? It indicates efficient utilization of assets and equity. You see, the thing is, they're both positive. So we got to be positive with the analysis, maybe. If you want a more developed answer, then indeed question it, challenge everything. So it's good practice if you're in the middle of under examination conditions. Current and quick ratios exceed 1. Well, that's not quite true, is it? Because the quick ratio did not suggest that. But the debt and equity ratio indicates an equal proportion of debt and equity, which may be manageable depending on the industry and risk tolerance. You see, if interest rates are really high, then you really don't want to be too much in debt. Of course, it depends on the nature of where you get the money from. If it's got high interest, then clearly it puts your expenses up. Okay, are there any possible recommendations? Please challenge all this. It's not, I mean, that is not quite right, is it? They both don't exceed 1. I did change the data, make it more realistic, on reflection. Okay, while a company's financial performance appears to be strong, there may be opportunities to optimize operating expenses to further enhance profitability. You could apply that answer to almost anything, all right? But obviously, if it was a loss situation, it would be a very different form of analysis and recommendation. Diversifying funding resources or reducing debt levels could mitigate financial risk associated with the current debt to equity. In other words, what we're saying is get that debt down in times of economic uncertainty. All right. Now, if you live in an economic climate where interest rates are fairly low, and more important, it looks like inflation, there is no real inflationary pressure in the economy. And because it's low, there may be the debt probably isn't too serious. I would say, though, if an economy goes into recession, then you'll tend to find your creditors will squeeze you a bit harder to get their money back because they're feeling the pressure. So, it's about getting it in the right proportion. Continual monitor of inventory levels and management of working capital can further improve liquidity ratios. Okay, standard answer. You could apply that to almost anything. Okay, well, that just gives you a sort of level of, I would call it an intermediate level of working with ratios. But please remember that there's a lot more to this. This list could go on a lot more than that, and it does. Okay, just on the final point though, remember what these are called. These actually refer to as liquidity ratios. Very important to know these terms because examiners have a habit of saying, rather than spelling it out like this, what they more often will do is say to you, identify 3 appropriate liquidity ratios, for example, and evaluate, because that's what evaluation is. Are they good? Are they bad? What can we do to improve them? Okay, all important skills, whether you're doing business studies or you're doing accountancy studies or both. Okay, thanks for watching.